Let's get you up to speed on our grain trade here on this Monday morning. I'm Marlin Bohling, your tour guide to the ag commodities. And looking at that corn market, remember, we were getting kind of weak in the knees when we opened things up today. We're still that way. We have the May contract on the corn, 4 3/4 cents lower at 5.72 in July, down 4. December new crop corn currently down 2 1/4 cents at 4.94 1/4. Now, why is that significant? Well, we had some overnight export sales this morning, and I want to show these before I get into our soybean trade. That might help to explain some of this. On the overnight sales, we had 2 sales of soybeans. We had 132,000 tons that went to China. We had 110,000 tons that were sold to Bangladesh. But the thing is, how much impact did it have? Let's look at our prices and our quotes provided by bar chart. We have May, let's go ahead and take a look at the soybeans here. The corn was down 4 cents. We have soybeans down 20.5 at 13.82.5. We have July down 21 cents, and you have November down 16 3/4 cents now at 12.46.5. That July contract is only a penny from its low of the day right now. So big time losses in the soybeans, and they are the ones that had the bullish export sales news this morning. Let's look at the wheat. In Chicago wheat, we have July down 14 1/4 at 6.26 1/4 this morning. In the Kansas City market, there was a lot of talk about concerns about cold weather moving in. Well, maybe they're not as concerned as we thought. We have July down 10 cents now at 5.84 1/4 this morning. And on the spring wheat trade in Minneapolis, wow, we have July down 14 3/4 cents at 6.46.5 per bushel. In the cotton market, you now have the July contract there down 122 points at 82.52 cents per pound, while December is down 59 points. Let's call on Chris Swift of Swift Trading in Nashville and sort it all out. Boy, lots of negative trade here this morning on the grain side of the equation. Why this morning?
Good morning, Marlin. I think a lot of it is last week. We put the grain markets up to new contract highs in most all the corn contracts, tested contract highs in some of the wheat contracts, and the bean market's still kind of soft because South America is finishing up their harvest. We got news this morning that they're pretty much done with their harvest, and that'll put that grain into a more exportable position. But the dry weather that's helping them be able to harvest the soybeans is kind of hampering their corn crop. So I think that's why corn is not down near as much as what beans are this morning.
Overall, now we were talking about the wheat, and you know the wheat had such a rally here over the past week, and now it's like they're taking the wind out of the sails here today. Now in the Kansas City market, there was a lot of talk about weather concerns as we headed into the weekend. Talk that we may have freezing temps early this week, and I know our own John Jenkinson was back in Southwest Kansas over the weekend, and he said it seems like the main concern now is dryness. He said they have to get some rain within the next 10 days to 2 weeks, or it could get really dire out there as the wheat really gets closer to the boot and heading stage. And that seems to be more of a concern right now. So maybe we've dodged a bullet, but only temporarily in the wheat.
Could be, but you know, we're coming up on planting for the spring wheat, and we note that all of the areas in North and South Dakota, over into Minneapolis and Michigan, are all very dry, and that's where a lot of those acres are going to go to. So it's very iffy right now, and we did miss some of the cold weather, but dryness is a big issue, and I'm anxious to always hear what Tim has to say about it, because I think that's going to be what we're dealing with for the rest of this year.
I did want to take a look as well at what the dollar is doing. Sometimes the wheat will react to that. Well, not so much today because the dollar is flat. We have June futures on the U.S. dollar index down 30 points at 92.130, so not getting much guidance from that at all. We'll come back in a moment. We'll talk more with Chris Swift about our livestock trade and what we're doing there when we come back. What's that crude oil market doing this morning? Well, let's take a peek, shall we? West Texas Intermediate crude oil really taking the spurs to that thing this morning. We have the May contract now $1.33 higher at $60.68 per barrel. That's within about 6 cents. We'll call it a nickel within its high of the day right now, and almost $2 off of its earlier low from overnight. Big turnaround in that energy market this morning. As far as the live cattle prices go, well, we did have some higher prices, but not anymore. We have the June contract on the live cattle now 12 cents lower at $122.45. In August, now 25 cents lower at $122.15. Remember, we had those big-time losses Friday in the cattle complex. On the feeder cattle market, you have the May contract 22 cents higher at 149.85, but that's 90 cents off of our earlier high this morning already. And the August contract 37 higher at 160.32. On the lean hog trade in the early going today, we have the May contract up $1.17 at 107.55, and we continue to just knock out these new contract highs in the lean hogs. It's just like clockwork. June now had a high of 110.07 today. We're now at 109.72. That's up 77 cents. So obviously that means we have more new contract highs in the lean hogs today. All right, talk to me first about the cattle market here. Chris, what's going on? Why did we have so much pressure on the live cattle Friday and then carrying over into today after a higher start?
Well, we got a couple of factors out there. We got box beef prices at some of the highest levels we've ever seen, trading over $271 a hundredweight for boxes, but that has not bled over into the cattle market and shown for increased demand. And we saw that we only killed 641,000 head last week. So the demand is there, but there's also so many cattle out there that we're not seemingly being able to make a big enough, the beef is not making a big enough impact to draw more cattle into slaughter.
Well, I tried to do what I could to provide the demand over the weekend. Did lots of barbecuing over the weekend. Let's talk about this hog market then. How do you look at this as far as, man, investor money has to be looking at that with a wary eye when you keep making new contract highs like that?
Well, and I think so, and I think it all boils back to last year when we had such a large sow and hog kill there that now we go fast forward 14 months later, and here we find ourselves just a little bit short of hogs ready to process, and we know that producers over the last two quarterly hogs and pigs report have begun to lower their production side of it. So I think what we're really doing is just seeing some of the production side of it roll down just a little bit, and we're seeing the demand side pick up just a little bit, and especially with beef prices really high in the grocery store now, even though pork prices are higher, they're still cheaper than the beef items.
All right, well, Chris, good to visit with you again. Chris Swift of Swift Trading, and he's based in Nashville. And Janet, with that, I will turn it back to you. We'll keep a close eye on what's going on in these markets today.